If you've ever applied for funding, got denied, and thought, wait, my credit score is good, why did I just get rejected? You work to get your credit score up. You might be at a 700, maybe a 720, maybe even a 750. And you feel you should be getting approved for anything you apply for. You have deals in your pipeline. You have a business. You pay your bill. You're not a random person walking off the street asking for money. You're a real business owner with a real need for capital. And you still got denied. And you've been denied multiple times. And at this point, it's starting to stink. Because now you start wondering, is there something wrong with me? Is there something wrong with my profile? Why are people able to get approved for $50,000, $100,000 plus, but I can't get approved for a $10,000 line of credit? And here's what makes it worse. Every time that you apply and get rejected, your credit score drops a little bit every single time. And so now you're in a vicious cycle of trying to find a solution. And the harder you try, the worse your problem gets. And at some point you stop trying altogether because it feels like no matter what you do, you just keep getting no's. And that's exactly what we're going to fix in this video. Because if you're a real estate investor or any small business owner who's looking for funding to close more deals, to fund your rehabs, or just to have working capital so you're not working on a shoestring budget every single month, but you've been applying for funding, getting denied, and your score drops every single time, and you have no idea why. And now you're feeling completely lost because you don't know what you're doing wrong. My name is Jay and I'm the founder of TFS Funding. And I've spent years studying exactly how lenders make their approval decisions and the actual metrics underwriters use when looking at your lending profile to decide whether you get a yes or no. Through TFS Funding, I've helped real estate investors and small business owners get access to anywhere between $50,000 to over $300,000 in funding to be able to grow and scale their businesses. I've helped clients who are stuck at $5,000 credit limits break through to the six figures in funding. I've helped people who've been rejected by every major bank finally get approved. And everything I've learned, all of it comes down to the same core mistakes that people make over and over and over again. So let's go ahead and go through them one by one. This is the biggest mistake, and I see it so often. Even people who consider themselves financially savvy, they still don't know about this. Not every lender checks the same credit bureau. So now let me explain. There's three major credit bureaus in the United States: Experian, TransUnion, and Equifax. Each bureau is its own separate company, and each of them have their own algorithm where they take the information on your credit report and generate their own credit score. And oftentimes they're different. So now when you go to a lender, a bank, a credit union, apply for a credit card, a lot of times they're not applying for all three of the credit bureaus all at one time. They're usually only applying for one. They may apply for only Experian, they may only apply for TransUnion, or they may only look at Equifax. And then on a rare occasion, they check all three. Most people have no idea which lender pulls from which credit bureau. So what do? They just apply randomly. They apply to whatever bank they already have a relationship with, or they might just Google what are the best credit cards of the year and apply for their first five. Here's what that looks like for a real estate investor. Let's just say you found a property, the numbers work, it looks great, and you want to be able to move on it quickly before the next investor does. So you apply for funding three different lenders back to back to back because you don't have any time to waste. You need to get this funding now. But when you apply, your Equifax credit report has already taken a beating. Maybe last year you applied for a few credit cards that only pulled Experian, or you may have had high credit utilization on an account that's linked to Equifax. Whatever it is, your credit score specifically for Equifax is down. And what makes it worse is those three new lenders that you went to apply for funding, they all pull Equifax. So at this point, because they're only looking at one credit bureau, Equifax, they're literally seeing the worst of you right now. But here's the thing, for your Experian, oh, baby, it's all clean. It's wide open. Your Experian report had minimal inquiries. It didn't have high utilization. You had amazing payment history. So if you had applied to lenders that only pulled Experian, you may have got approved. Same person, same income, and same credit score overall, but completely different results, all because of a lender that pulled from the wrong credit bureau. I'm trying to tell you, this is the game, man. If you do not know which lender pulls from which credit bureau, you're literally applying blindfolded. Now let's talk about what's happening to your credit score every time that you apply. Anytime that you apply to a lender for funding, they're going to take a deep look at your credit report. Every time they took a look at your credit report, they're going to leave what is called a hard inquiry. And every hard inquiry that you get is going to decrease your score anywhere between 2 to 5 points. Now let's talk about what happens to your credit score every time you apply for funding. When you go to a lender and fill out an application, each lender is going to take a deep look at your credit report. And every time that they do, they're going to leave what is called a hard inquiry. And every hard inquiry that you get is going to decrease your score anywhere between 5 to 10 points. Now we'll think about what that looks like as an investor. You go to your first lender, get denied, your score drops 8 points. You go to the second lender, your score drops 5 points. And then on the third lender, your score drops another 9 points. Let's just say that you started with a credit score of a 720. Just from these last 3 applications, your score dropped over 20 points. And now your score could be in the 600s. And now when you go apply, because you have all these hard inquiries on your credit report, you have this decrease in score, these lenders are gonna see, look, this borrower, this applicant is looking super greedy right now. They're looking desperate for funding. Matter of fact, I don't want to touch him because it looks like he's about to do something reckless with the money. Matter of fact, I'm gonna go ahead and deny him. So you went from somebody who was a qualified applicant who could have gotten a lot of funding through your applications, but now you're seen as a person who's super greedy. You're seen as somebody who is a credit risk, and you're seen as a person who has red flags and probably going to get denied if they go to that same lender or different lenders who will pull from that same credit bureau. And it has nothing to do with your financial situation. It's because you applied to the wrong lenders in the wrong sequence at the wrong time. And look, what makes this worse is that each of those hard inquiries, they stay on your credit report for 2 years. So any lender who's going to check your credit report, they're going to see all the trail of rejections and hard inquiries that you got from those applications. So now here's a solution to that specific problem. There are specific lenders, banks, credit unions that will pre-qualify you with only a soft pull. So they'll be able to see whether you get approved or not with only a soft pull, without a hard inquiry, without you harming your score. So now if you go through that pre-qualification soft pull process, if you get denied, no harm, no foul. You don't get a hard inquiry and your score does not drop just because of an application. So now think about it. That can literally change your whole approach on this application process. Instead of applying blindly to random applications, crossing your fingers, hoping for the best, you find the lenders that do soft pulls. You find out whether you get pre-qualified. They tell you a yes or a no. If they do say a yes, you go ahead through with the application, you get approved, and you are able to move on without you getting denied and getting punished for it. And now you're only moving forward with the applications where they're already giving you a yes. And look, man, this is not a loophole. This is not a trick. This is simply knowing how to use the tools that are already available for you. This is the reason that I think surprises people the most when I explain it to them. Now, think about it as a real estate investor when you're stacking deals. You're not going to go to the most expensive property first and hope that all the smaller deals fall into line. You build momentum strategically. And look, funding works the same way. When you do fill out an application, a lender, they're not only going to be looking at your credit score. What they're going to be looking at your payment history and the accounts that you currently have on your credit report. And one of the most important things that people often overlook is what type of credit limits you already have on your credit report. The more credit and the higher credit limits you have on your credit report, the more likely another bank is going to trust you with their own type of funding. Think about it this way. Let's just say that you already have a $30,000 business line of credit with Chase. And you go to another lender, try to get applied for another line of credit. When they pull your credit report, they're going to see that you've already been able to handle a $30,000 line of credit, that Chase has entrusted you with it, and that you've been able to handle it and maintain it over time. So now they are more likely to trust you with their own funding because you've been able to show that you've been able to handle it and that Chase has entrusted you with it. Now, on the other hand, let's just say that you only had a couple $500 cards, maybe a $1,500 card, and then you apply for a $30,000 line of credit or a business credit card. Most likely, this bank is not going to trust you because there's nothing on your credit report to show that you can handle a $20,000, $25,000, $30,000 business credit card or a line of credit. These small limits tell another lender that, hey, these other banks didn't trust you, so why should I trust you with those limits? So the sequence matters in 2 directions. Going in the right order builds momentum. Each approval that you get makes the profile stronger for the next application. And going in the wrong order, it undermines you. If you start with high utilization on these small credit cards and you go to other bigger lenders, they're going to see a whole bunch of these small rinky-dinky cards, high utilization. They're going to see that you're under financial stress. And at that point, they're not going to want to lend you money because they're going to think that you can't handle it and you're going to max out the cards and not be able to pay them back. So they reject you and pull back immediately. And timing of these applications play a big role as well. So here's the problem. Most investors, they apply for funding when they urgently need it. And that's honestly the worst time to apply for, especially if you have high utilization, your credit report is not built out, because the lenders want to feel comfortable that if they lend out this money, that they're going to be able to get this money back. And you need to have something on your credit report that shows that you are able to be able to pay it back. High utilizations, small credit limits are not going to help your situation. If your credit profile recently changed, or if it shows that you applied to other banks recently, it's gonna raise a red flag for some banks. Your credit report tells a story. Your past payment history, your credit limits, your utilization, how well you've been able to maintain the accounts on your credit report, all tell a story and will determine whether a lender will actually entrust you with their funding. The key is you want to build a story of somebody who has been entrusted already with higher limits of credit. And that story has to be built deliberately. It does not happen by chance. And when you apply in the right sequence at the right time, you maximize your approvals, you maximize your limits, but most importantly, you reduce your denial. Now I want to talk about something that trips up real estate investors and small business owners specifically. A lot of people come to me and say, look, Julian, I got an LLC, man, I'm ready to go. Let's go ahead and get this funding. But people don't understand starting an LLC is not the end all be all. That's literally the first step. Lenders are going to be looking at more than just whether you have an LLC or not. Just because you have an LLC does not mean you're going to get funding. Now, let me walk you through what lenders are actually looking at when you're applying for funding. First, does your business have its own credit profile? So now your personal credit and your business credit profile are two different things. Your personal credit is tracked by Equifax, TransUnion, and Experian. So now your business credit is tracked by bureaus totally different from your personal. Now, there's a lot of different scoring models, but the most popular ones are Dun & Bradstreet, Experian Business, and Equifax Business. So now there's a lot of different business credit models, but the most popular ones are Dun & Bradstreet, Experian Business, Equifax Business, and FICO SBSS. Now, if your business does not have an established profile with these credit bureaus, there are lenders out there that will not approve you simply because of that, especially when it comes to higher amounts of funding in the forms of business lines of credit, SBA loans, and higher term loans. Lenders want to see transactions going in and out of a bank account consistently. They want to know that this business is actually conducting business. If you're running real estate transactions out of your personal account, and when you apply for funding from a lender and they look at your business account and they see that you have a $30 balance, and you've only had 2 transactions over the last 4 months, that's a red flag, and they're probably going to deny you, or they're just going to give you a small limit. Third, is your business information consistent among all your registration? You want to make sure that the business information on your state registered business entity, your IRS information on your EIN confirmation letter, and all your business information that's online, you want to make sure that everything matches up. When you apply for funding, inconsistencies raise red flags. Inconsistencies with names over here, registrations different over here, names, addresses, all of those inconsistencies can cause red flags and make a lender not want to lend to you. What happens when they don't want to lend to you? They give you a rejection. Fourth, how old is your business entity? Age actually, I don't care what people say. I don't care what you've been hearing online. Age actually matters. A bank is going to evaluate a 6-month-old business totally different from a business that's already 2+ years old. There are even some types of funding products that you could only get if you're 2 years and plus. For example, a lot of banks that offer business lines of credit, they're going to require that your business is 2 years old or older. Not saying you can't get approved for funding if your business is not 2 years old, but for most banks, for businesses under 2 years old, you may only be able to get approved for a business credit card until your business becomes of age. And there's another factor that most people overlook, and that's your relationship with that lender. A lot of lenders are more likely to approve you for higher limits, more funding, and better terms if they already know, like, and trust you, and you've already had a relationship with them in the past. Lenders even have an internal credit score system different from your typical credit score system that ranks how strong your relationship is with that lender. The longer you've been with them, the more accounts you have, the overall higher internal credit score you're gonna have with that bank. And if you already have a relationship with the bank, making sure that you're maintaining these accounts. You're not having overdrafts. You have a balance in these accounts. And overall, maintaining these accounts are going to play a major factor in how much funding that they feel comfortable lending to you. So now all these problems and mistakes that people make, none of them are impossible to fix. These are things that need to be addressed before you apply. This is not something that you handle after you apply, get denied, and start wondering why you got denied altogether. This is called setting up your foundation, making sure you have a strong foundation and your funding is going to be built up on top of that. Reason 5, there are items on your credit report quietly killing your approvals. This is something I explain to my clients all the time. I know people with 800 credit scores still getting denied American Express. But I also know people with 720s getting approved for $20,000, $30,000, $40,000 all at one time. It's not about your credit score, it's about your credit profile, what is actually being reported. And there's things being reported that you may not even know that's hurting your chances and hurting your approvals. Now, let me give you the most common ones that I see. Payment history is by far the most important factor to make sure that you take care of to make sure that you get approved for higher limits. Late payments will kill you. I've seen scores drop over 100 points just from one late payment. And I know sometimes, even if you have a phenomenal credit report, just 1 or 2 late payments can significantly decrease your chances, give you automatic denials, and on top of that, create major hesitancy from these lenders. But look, I always tell people this, anything on your credit report could always be reversed or deleted. You could go through a credit repair process and get those late payments reversed. But if you don't want to go through a dispute process, everything gets better over time. If you make consistent on-time payments moving forward, the negative impact of those late payments slowly decrease over time. Building 6 to 12 months of on-time payments can significantly increase your chances and bring you back in good stance with a lot of these underwriters. Now let's talk about your credit mix and your profile depth. Lenders want to see a good mix of different types of accounts on your credit report. They want to see revolving accounts, which are typically lines of credit and credit cards, but also they want to see installment loans. Those are in the form of personal loans, auto loans, and student loans. Having a good mix of different accounts show to the lender that you're able to handle different types of accounts, different types of payment styles. And now they're going to trust you even more with higher amounts of funding because you've been able to prove they can pay things on time, no matter what type of account. And a lot of times, this is how people with high credit scores still get denied. Like, for example, somebody with a 770, 780 credit score, they could have all just student loans, or they may have only personal loans on their credit report. But because they don't have any types of credit cards or other types of revolving accounts, they're still seen as a risk. Why would a lender lend that person a line of credit, let's just say $40,000, if there's nothing on their credit report that show that they can actually pay it on time? At minimum on a credit report, I like to see at least 3 revolving accounts, and that could be credit cards or lines of credit, and at least 2 installment loans. That could be student loans, personal loans, auto loans. So if you're somebody who has a high credit score but only has student loans or only has personal loans, what you can do is you can start off by going to a bank that you already have a relationship with and starting off with their starter credit card. Because you have that relationship with them already, there's a good chance that you're going to get at least a $5,000 to $10,000 credit card right off the bat, even if you've never had a credit card before. Now, if you're somebody who only has revolving accounts, you only have credit cards on your credit report, simply the easiest way to be able to build out your credit report on an installment loan is by going to a credit union. Most credit unions are going to offer what is called a secured loan or a pledge loan. And these secured loans are specifically built just to build out your credit profile. How it works is you can take a certain amount of savings, let's just say $5,000, and put into a savings account with that credit union. Now what that credit union is, they're going to give you a loan that is secured by that $5,000. So you give them $5,000 in a secured account, and they're going to give you a $5,000 loan. Now you take a little bit of that $5,000 loan and pay back to the credit union a little bit every single month. So let's just say that you decide to pay $120 a month. $120 a month back to the credit union, and every month that you pay back that monthly amount, not only are you building a stronger relationship with that credit union, but you're also building a stronger credit profile, a stronger payment history. Another account that a lot of people don't talk about that you can add onto your credit report, if you are renting, you can actually report your rent to your credit report and now get credit for something that you're already doing. You can go to apps like boompay.app Rental Karma, and rentreporters.com. High credit utilization. This is oftentimes the most overlooked factor. Credit utilization is the ratio between how much credit card debt you have divided by how much available credit you have on that credit card. Let's just say that you have a credit card from Bank of America that's $10,000. Now you use $8,000 on that credit card. You have $8,000 worth of debt divided by the $10,000 of available credit. Your credit utilization is at 80%. Now, if you go to apply for some type of funding to a lender, you're looking financially stressed. Now, let's just say you got a credit card from Bank of America. Let's just say it's $10,000. And you use $8,000 of that credit card. And now 30 days passes and you let that new balance report on your credit report. Now, if you go apply for funding, the bank is going to pull your credit report. They're going to see an 80% utilization on that specific credit card. To them, they see that as you're financially stressed. Even if you've been able to pay that credit card on time in the past, even if you've never got a late payment, even if you've never had a collection or a charge off, but simply because you had that card almost maxed out at 80%, you're seen as a high risk. For real estate investors, this matters even more. Because lenders, when they see that high utilization, that lets them know that you don't have reserves, which is a big no-no. And lenders hate that. If you're thinking about applying for funding, one of the first things that you should do is actually take a look at your credit report. Inaccuracies like outdated balances, accounts that don't belong to you can quietly decrease the chances of approval. But the great thing about this, like I said earlier, anything on a credit report could always be reversed or deleted. And it's pretty straightforward on how it can be fixed. You can pull your credit report, review it, identify these inaccuracies, and actually dispute directly with the credit bureaus to get these deleted. And that is a must. Dispute to get these inaccurate information removed immediately is going to significantly increase your chances. And I'm telling you, this is the most underutilized but most effective tactic to improve your overall credit profile and increase your chances of approvals. Old collections too, y'all. These small petty accounts that may have got 5 years ago, that's for $50. Those can give you an automatic denial every single time, even if it's just $500, $100, $200. And even with the collection being so small, when a lender pulls your credit report, they're going to see it. And each lender has its own rules. And there's some lenders, if they see a collection, no matter what size, it's going to be an automatic denial. Under reporting your income, a lot of people think that they're reporting the income correctly. But in reality, they're giving numbers that make them less qualified. For example, a lot of times people put their net income on these applications when in reality, they should be putting their gross income. That's what the lenders are looking for. That's what the lenders are basing their approvals off of. Their gross, not their net. For real estate investors, reporting all of your income. Also, what is very key is reporting your household income, meaning the income of all the people who live in your household. That is the number that you want to put on your application, not just your individual income. Now, for real estate investors, making sure that you're reporting all of your income, your rental income, deal income counts, household income counts. All of it should be included because leaving any of it out makes your profile weaker than it actually is. Overstating your expenses, especially your rent and your mortgage. Your housing expenses play a huge role in how lenders evaluate your debt to income ratio. If you report a number higher than what you actually pay, it can make you look financially stressed. For example, if your rent is $2,600 a month, but you split with a roommate and you pay $1,300, by reporting the full $2,600 and not the $1,300, you're reporting a higher expense than what you're actually paying, and that can quietly hurt your approval. Also, the same thing applies if you live at home, if you live with family and you're not being charged rent. It is totally acceptable to put $0 on the application. See, these small details may seem minor, but they play a huge role, bigger than what people often think. But the great thing is, everything is addressable and everything can be fixed. But the key is you have to address them and you have to fix them before you apply. Most people apply and then wonder why they get denied. The people who get approved consistently pull their credit report first, optimize their credit report, identify which lenders pull from which credit bureaus, and then develop a sequence that improves their chances of approval. Look, I can go on and on, but let me show you what this actually looks like in real life. One of my past clients, Darlington, who was a real estate investor, came to me. He had some identity theft problems. He had a whole bunch of inquiries and even had a few late payments. We were able to address all the inaccuracies on his credit report, boost his score up to a 767. And we got him approved for $70,000 plus in 0% interest and low interest capital for him to be able to invest in his bird deals and his out-of-state apartment buildings. Anna and her husband Eric, who run a transitional housing company, came to me and had similar problems. They had some identity theft problems, some hard inquiries. We were able to use a strategic way on how to be able to get around that so they can get approved for over $240,000 when initially their initial goal was only $100,000. And they were able to use that to be able to fully furnish, decorate, and to develop new housing for their client. Or even my other client, Ace, who came to me and said, hey, I don't have all my tax documents set up right now, but I need to get $100,000 on funding as fast as possible. We were able to get him approved for a $50,000 business line of credit and two $25,000 0% interest business credit cards without having to show any tax docs, without having to show any bank statement. This is what happens when you follow a system. And this is what's possible for you too if you take action today. Now you can take everything I covered in this video and try to go and do it on your own. And now if you're willing to put in the time, study this system, and learn through trial and error, there should be no reason why you're not going to be able to get your funding goal. But every mistake that you make while figuring this out is going to cost you. It costs a hard inquiry on your credit report. It costs you rejection that gets recorded. It costs you months of your profile telling the wrong story to every lender who looks at it. And most of the people watching this video, they don't have time to waste. You have deals to close. You have a business to grow. You have opportunities sitting in front of you right now that require capital. That's exactly why we built TFS Funding. We do a complete audit of your credit profile, personal and business. We identify every single item that's blocking your approval. We map out the exact lenders that you should be applying to based on your credit profile. We work with you step by step to clean up your credit profile, to set up your entity appropriately, and get you the max funding that you need for your business. We've helped clients get approved for $50,000, $70,000, $100,000, $180,000, even $240,000 without having to show any tax docs, without having to show any bank statements, without hurting their credit profile in the process. And look, we could do the same for you. So if you're serious, and I mean genuinely serious about getting capital for your business, click the link below in the description below and book a free strategy call. Look, I'll see you on the other side.